Seen the full effect of the EU's ban on Russian oil. I mean, they're going to sign that in the coming days. And so peak inflation is quaint, Joe. But where does inflation go from the peak? That's a big question for consumers and businesses.
For sure, and certainly the challenges as it relates to energy prices moving towards $120. I understand they're pulling back slightly, and you've got natural gas that's pulled back to 8.5%. But inflation is going to remain present, and to Stephanie's point, I think that's why volatility remains elevated. That's why monetary policy is going to have to stay committed to ensuring that is more hawkish to at least give the perception of fending off a lot of that inflation. So the all clear signal on the market, I don't think anyone could come on and really suggest that right now. I do think there is further upside potential. We're 3% below the 50-day moving average at 42.70. So the market can clearly go back towards that level. There are some positives that investors can begin to think about. Stephanie mentioned China reopening. I still personally believe President Biden and his administration are going to have to relax or temporarily suspend some of the Chinese tariffs to ward off some of the inflationary pressures. So it ultimately comes down to what type of stocks do you want to be owning in what I'm describing as a very volatile environment. I still want to avoid the hyper-growth stocks. In the last week, I purchased T. Rowe Price, J.P. Morgan, and Lululemon. I want to be respectful of valuation. I want to be invested, but I just want to do it in a very judicious and diversified way.
You know, it's glass half full, glass half empty, Jim Lebenthal, when it comes to the markets sort of stemming these losses that we've suffered for the past 7 weeks prior to last week for the S&P 500 and the NASDAQ, in that, you know, the higher the markets go or the more stable the markets are, that's more work for the Fed. You know, the side effect of the Fed hiking interest rates is going to be some pullback in the equity markets. That's what Bill Dudley had outlined in his Bloomberg op-ed, you know, weeks ago. And if we're sitting here celebrating the fact that the markets are actually stable, maybe the Fed goes in harder.
Yeah, Melissa, I really like the setup to your question there because it is glass half full, glass half empty. And the market gets to decide what it wants to focus in on. That's what sentiment means. Sentiment has been overwhelmingly negative for several weeks until last week. And if I ask myself what changed, it really was that Raphael Bostic came out and threw out the idea of a pause in September. Now, let's be very clear. That's one person and one data point. So it's almost meaningless, except that it's the first indication of anything like a pause. So really what it indicates to me is that this is a market that's really teetering on what the Fed will do. In terms of sentiment, this is what the market is teetering on. And, you know, so for that, you have to look at the internals of macroeconomic data that's coming up this week. Obviously, we have the jobs report on Friday. Labor force participation rate is what I'm looking at first and foremost. In a similar fashion, we get the ISM surveys tomorrow and Thursday, and it's the internals that I think the market is going to be focused in on. Things like prices paid, new orders versus production, because that's going to be an indication of the critical question of where inflation is going and what the Fed will do. And you cannot answer those questions until you start to get more data, particularly for May. So the PCE on Friday was the last reading for April. We need May's readings. We're going to start getting that next week with the CPI. You know, until then, we just can't answer the question as to whether this is a bear market rally or the bounce off of a corrective bottom that has real legs, because we just don't know what the Fed's going to do.